So hello, my good people. So after we are done with the first part of the video, so which we started with the first 4 steps. So in the previous videos, which I did concerning the foreign subsidiaries. Now, what I'm going to do is just now the presentation of the income statement and statement of financial position. So this is a continuation of what we did in our previous video, foreign subsidiaries. So let us start with the presentation of the income statement so that we can be able to say that the equation is complete. So what we'll do is this. So remember that on this scenario, we have the relevant statements which are given. So because this is the question, we had already gone through the question. So it's just a presentation. So for the income statement, we had already converted this income statement of the S from Rwandanese franc to Kenyan shilling. So I will start with the consolidation of revenue, then cost of sales as I continue. So I will write H remittent. So we have H remittent, consolidated. So about consolidated income statement. So that is for the year. For the year ended. So it was started April. So it was started April 2016. Started April 2016. So what you need to know is that we start from revenue. So revenue for the parent, it was 2,000 plus. So I said that you can accept to do the first 4 steps before you do the presentation, but at the same time, you can go direct to the presentation without doing the 4 steps. So if I could have avoided doing the 4 steps, remember that I will start with the relevant revenue, of which the parent, I took the parent, 2,000, plus the subsidiary. Remember the subsidiary, the figures of the subsidiary in foreign, which is in Rwanda, it was 1420. But obviously, you know that we convert the income statement items using the average rate. And you know that the average rate for this scenario, for this question was 2. So we convert it direct. So you divide by 2. So it's the same thing I could have picked. So before I say what I could have picked, so the 2 I've taken is the 2 from the note 8, which is the average. So I have converted the 1420, which is the revenue of foreign subsidiary, to Kenyan shilling. So it's the same thing we did in our first step. It's the same thing we did in our first step. So this is what we did. Remember that I converted the 1420 to Kenyan shillings by dividing the 2, of which I said when converting the income statement items, use the average rate. So if I could have avoided doing this step 2, not step 2, but step 1, I could have done this way, 2,000 plus the fee of the subsidiary, that is 1420, which is Rwandanese francs. I convert. Then after I've converted, I have to adjust. So what are you supposed to adjust under revenue? So revenue, you only subtract intergroup sales. You only subtract intergroup sales. And the intergroup sales must be between the parent and the subsidiary, of which on this scenario, we know that it was between the parent and the subsidiary. So I will display it to tell you so that you can be able to determine which is the intergroup sales. So we were told in note 2 that there was an intergroup sale of this raw material of 60. So that is the only figure I would subtract there. So the way it is, so the 60. And that's all. So for revenue, subtract only intergroup sales between the parent and subsidiary. And remember that when recording this subsidiary, in some scenarios, you will find that the subsidiary was acquired during the year. You have to consider from the time of acquisition to the end of the year. But concerning this question, remember that S was acquired 1st May 2015. And the 1st May 2015 was at the start of the relevant financial year. So the subsidiary was there for the entire year. So that is why we have not apportioned 1420 divided by 2 with any fraction. So it was there for the entire year. So you take the parent plus subsidiary minus intergroup sales only under the revenue. And the intergroup sales must be between the parent and subsidiary. In this question, it was only the parent and the subsidiary. And it must have occurred in the current year under consideration. Like now in that scenario, you can see it was on 1st February. That is fine. We are done with the first revenue. So the next thing is cost of sales. So for cost of sales, again, I could have done very direct. I could have taken 1200. I add the 960, of which I know I have to convert by dividing by 2. Then what am I supposed to raise? I'm supposed to subtract again the intergroup sales. The intergroup sales. I will add the UPS and realized profit on stock. So this one will arise whereby I said UPS is equals to unsold stock times profit margin. Times the profit margin. So unsold stock times the profit margin, of which, remember that these goods were sold worth 60. They were sold to S, of which S received them. But did S resell the entire 60 by the end of the year? So you are told here, as at 30th April 2016, a half of the raw material purchased was still in the inventory of S. So a half of the 60. So which means that the half of the 60 were remaining in the inventory of S. So they were never resold. So 30 goods worth 30 million were never resold. And remember that they were sold to him from H at a profit of 20% because they have given us a profit percentage on selling price. So since he never resold all of the goods, there is a nearest profit he never get in return. So we need to get that so that we adjust. So I will take the unsold goods times profit margin. So unsold goods here is 30 times 20%, 36. So we take a half of 60. After that, I multiply with 20%. So that one you can see is 6. That is fine. So that is the unrealized profit on closing stock, because now these goods were never resold by S by the end of the year. So that's why I'm saying UPS on closing stock. And here is profit on stock on closing stock. So that one you add. So if the same thing occurred, let's say the previous year at the end, it could have been an opening. We do the same so that we get the UPS on opening. So if it could have by the end of the previous year, I could have computed the same. I say this a UPS one. Opening stock. So UPS on opening stock. I could have subtracted, but there was nothing like that. Then again, I could have subtracted something concerning depreciation. Depreciation overcharge. Then I add depreciation undercharge. So I add depreciation undercharge. So when we talk about depreciation overcharge, I mean that for depreciation overcharge, in order to get depreciation overcharge, obvious, that is depreciation over, there must be a sale of fixed assets. So for example, if A, or I use H and S, if H sold a fixed asset to S, remember the profit, you will be told, for example, H sold an item or plant to S at shillings 200 million, including a profit margin of 20%. Full stop. Then they will say depreciation charged on the asset is 20%, of which the group charged. So they would say the group charged depreciation of 20%. So in order to get this depreciation overcharge, what you need to know first, there must be the statement which I've mentioned, which concerns in the group sales of fixed assets. So that we take an realized profit on fixed assets, UPFA, times depreciation rate. So in order to get this UPFA and realized profit on fixed assets, you take the transfer value. So the transfer value of the asset times profit margin times the profit margin. So remember that when I'm talking about unrealized profit on fixed assets, so when there's an intergroup sale of fixed assets, the other entity which will receive the fixed asset, let's say H sold to S, S will never resell the asset. But remember that when H was reselling to S, he charged S a profit. So since S will never resell, he will never realize the profit which H realized. That is why I need to check for the unrealized profit on fixed assets, so that I adjust accordingly, of which I will show you on how to adjust. So after that, remember that if they transacted the two, there was an intergroup sale of this fixed asset, and I say that they will say that the group charge depreciation. Obviously, they would say that if there would be a scenario of a sale of fixed asset. So when they say that there was a depreciation on this sale of fixed asset, obviously both H and S charge depreciation, which means that there was a depreciation overcharge. They overstated because both of them, they are group members and both of them charge depreciation. So you need to check for that overcharge. That is, you take unrealized profit, you multiply with the rate you are given, the depreciation rate, that is. Then what about depreciation undercharge? So when you talk about depreciation undercharge, there must be something known as revaluation. So because to get this, we always say that depreciation undercharge is equals to revaluation gain. We take revaluation gain times dep rate, that is depreciation rate. So of which I said early enough in the first part of this video, that is in the first part of this question. So in order to get the revaluation, obvious, revaluation is the difference between the fair value of the asset and its book value. Fair value is the market value. Book value is the carrying amount. So if there is a difference between the two concerning the asset, again, I said they can twist in the way they can test, of which they will say the fair value of the asset was in excess of the book value by a certain amount. Or they can again say the book value was below the fair value by a certain amount. So that is again a revaluation gain. So once you get that statement of those scenarios, so you get a revaluation gain, you multiply with the rate, you get undercharge. So I'm done with cost of sales, and that is the one which takes a bit of our time. The others are direct. So after revenue minus cost of sales, that is a gross profit. So you get a gross profit. After the gross profit, you talk about other expenses. Like now in this question, after this, we have a distribution and admin expense. Distribution and admin. So for distribution and admin, you can again do direct without the steps. So I take the parent, which is 300 plus. So for the subsidiary, it was 200. I divide by 2. And that's all. So after that, I introduce what is called impairment. Remember, impairment is the loss in value of goodwill. I will introduce impairment loss. So remember that in note 1, there was impairment. We were told there was impairment in note 1, and I remember it was 42. For more confirmation, I can share so that you see it was this one, 42, of which we were told that goodwill is reviewed for impairment annually. As at 30th April 2016, the impairment loss on recognized goodwill was underneath franc 42. So as at this date, so the rate which I will use is as at this date, which means that this is the spot rate. That relevant impairment took place as at 30th April 2016. So as at 30th April 2016, the rate is 2.1. The rate is 2.1. So that I will take my 42 divided by 2.1. And that is how I will get my impairment. That is fine. Up to this point, we have profit before interest and tax. Profit before interest and tax. Then we talk about finance cost, which is the interest. So for the finance cost, again, it's a direct thing. I will take, so finance cost on this now, I can see they said interest receivable, interest payable. So which means that I will record the way they told us. So we have an interest receivable of 40. We have an interest receivable of 40. We have an interest receivable of 40, but remember there was again a payable. So I can offset. So this one is 40. So payable is, with the foreign currency, it was 20. But remember, I will convert. I will translate, that is a good name, by dividing by 2. So I will remain with an interest receivable of 30. So after that, we talk about profit before tax. Then we raise tax. So if I raise tax, so the income tax given is 200. I will add the 90. I will convert this by 2, by dividing by 2. That is, I will translate, not converting. So anyways, you understand what I mean? So that I get profit for the year. So after getting profit for the year, I will say profit attributable to NCI. And we have profit attributable to parent. We have profit attributable to NCI and profit attributable to parent. So you can see I have done the income statement in a direct way. It's the same way I could have been picking the items of the translated. But at the same time, we know that we were translating. So you can do direct without doing step 1. That is what I was putting in place. So you can accept to go direct or start with step 1, step 2, step 3, step 4. On that case, when starting with step 1, 2, 3, 4, I know that you will get 100%. But avoiding those steps, I know you can't miss 80%. So you can know both methods. That is for the scenario of an exam-based way of doing the question. So I can use my calculator to get these figures. So if I take 2000 plus 14 divided by 2 minus 60, I'm getting 2650. Then this one I will just, because there is not enough space, I will say here, you will be able to understand. So 1200 plus 960 divided by 2 minus 60 plus 6. I'm getting 1626. So I will just fix here. This is cost of sales. So if I take the calc, I minus the answer. So I'm getting 1024. And this is direct, because this is 100 plus 300. This is 400. Then this is 20, because that is divided 42 divided by 2.1. Then if I take 1024 minus 400 minus 20, that is 604. 604, that is profit before interest and tax. Then this one would be 40 minus 10, that is 30. This one would be 30. That is interest receivable. I have subtracted interest payable. So this was interest payable. This is receivable. So I'm getting a receivable of 30, which is an income. So if I add that, I'm getting 634. Then this is a 45 plus 200, that is 245. So if I minus, I'm getting, if I take 634 minus 245, that is 389. So we can talk about now profit attributable to the NCI, non-controlling interest. So that one needs a working. Profit attributable so profit attributable to NCI, that is non-controlling interest. So the profit attributable to the non-controlling interest, it's very simple. So you have to adjust the profit of that subsidiary. So I will start with profit after tax in the subsidiary. So I would adjust by subtracting a nearest profit on stock, UPS. But if sales upstream, I will explain why. Then I will raise depreciation undercharge. Then I will add depreciation overcharge. Then I will raise impairment loss. But for impairment loss to be applicable, if we use the full method when doing goodwill, if full method was used while we were computing for our goodwill. So that, why am I saying that we adjust the profit after tax in the subsidiary? So remember that after getting the profit after tax as the parent, let's say you are now requesting that, not even requesting, obvious, you have to distribute something to the non-controlling interest, because in this subsidiary, you never controlled the subsidiary up to 100%. It was controlled by you as the parent up to 75. So these are 25%, which is supposed to go to the non-controlling interest. So before we do that, so we have to adjust this profit. Why am I adjusting this profit? I have to raise first UPS and realize profit if sales upstream. So remember that if the relevant subsidiary was selling goods to the parent at a profit, and this parent never resold all of the goods received from this subsidiary, so it means that the profit of the subsidiary is overstated by what the parent never realized, because he never received or he never realized all of the profit he paid to this subsidiary, because this parent never resold all of the goods. So we erase that so that we bring profit to its normal state. Why am I erasing depreciation undercharge? So remember that depreciation is an expense. So if you understand that expense, obvious profit would be more, would be overstated. So you subtract to bring the profit to its normal state. If you overstate, that is depreciation overcharge. So for depreciation overcharge, remember that if you overstate your expenses, you have understated your profit. So your profit is less. So you add back what you overcharged as depreciation so that you bring the profit to its normal state. Then we raise impairment, because impairment now is an item which is coming in, which was never adjusted. But for it to be applicable, we must have used the full method. Because now the full method concerns goodwill going to the parent and the relevant non-controlling interest. So at least now the non-controlling interest contributed to the goodwill which was impaired. That is why am I saying that for impairment to be used, we must have used the full method. So that the profit after tax in the subsidiary, remember that it was the one which already is converted. I think it was 75, because already we did that from our first step, this one. It's the same way you take 150 divided by 2, because you know income statement items, you convert with the average rate, and the average rate, you know, it's 2. So 150 divided by 2. So which means that is 75. After that, the sales, was it an upstream? Remember that we have a UPS here of 6, but it was a downstream sale because S is the one which purchased from H. As they said, S purchased. So which means that H is the parent, he sold. So that is a downstream sale. So there's nothing like this because it was a downstream sale. Undercharge, for depreciation undercharge to be applicable, I said we must have a revaluation, which was not there. Even the examiner told us that the fair value of the asset was equivalent to its carrying amount. So we know that there is no revaluation. So once there's a difference between the two, is when we say that there is revaluation. The difference between fair value and the carrying amount. So remember, in this, they said the fair value of the net asset of S as of the date of acquisition is assumed to be the same as the carrying value. So there was no difference. That is check note 4. There was no difference. So there was no revaluation. So we cannot have an undercharge. At the same time, there was no overcharge because there was no sale of fixed asset. Because I said for depreciation overcharge to be there, maybe H could have sold a fixed asset to S, and both of them charged depreciation on the asset which was sold. Then impairment loss was there, but we used the partial method when we were doing our goodwill. So which means that we remain with 75. So this is what we have adjusted. So that now you take the 25%, which is the NCI percentage, times the 75. So if these items could be present, you have known how to capture them. So if you take 0.25 times 75, I'm getting 18.75. So 18.75 is what you record here. 18.75. So that you take 389 minus answer. So the answer, which means that is 389. So the total was 389. So 18.75 of this goes to the non-controlling interest. So the balance, which is 370.25, goes to the minority shareholders. And that is the end of the income statement. So the next step, let us check how to do the statement of financial position. Very simple. Now let us finalize with the statement of financial position. So the statement of financial position, remember that it's all about assets and equity and liabilities, which will be captured. So as given here, we talk about assets. So we start with assets. You can see we have property, plant, and equipment. We talk about investment as we continue. So let's start with the assets. So I'll be doing the same. So for assets, so remember that we have a property, plant, and equipment. So for the property, plant, and equipment, remember that the parent is 2970. So I can decide to add direct the one we already converted, of which I can display here. So the one we converted, so step 2. So I can be able to add direct this 695.24. But at the same time, I can be able to do direct. If you could have avoided this step, I could have said 1460 divided by, you divide 2.1. You could have arrived at the same answer, so that you minus, before you minus, you add revaluation, you minus depreciation under change. So depreciation under, then after that, you minus your UPFA, of which both of them have explained on how to do them. Then you add depreciation over. So add revaluation, because revaluation will increase the value of the asset. Then minus depreciation under change, because obvious, the value of revaluation initially it had not been subjected to depreciation. That's why we get the depreciation under charge, we minus. Minus you, and here is profit on fixed asset, then add depreciation over charge. After that, we move to the next thing. Because there was no revaluation, which means that there was no depreciation under charge. There was no sale of fixed asset, which means that there was no, and here is profit on fixed asset. And at the same time, depreciation over charge. So the next thing you are given is the investment in S. So that is the next thing in that statement. So the investment in S, that one you replace it with goodwill. So this investment in S. So when they invested in S, it's like they acquired S. So which means that one you record goodwill. So goodwill, I remember very well, it was a certain figure, which is 210, of which we converted in 2 ways. As at the date of acquisition and as at the date when the statement of financial positions are prepared. So I can display. So this is what we did. So for goodwill, we got 210. Then we converted, translate goodwill as acquisition date, translate goodwill as at the date of the statement of financial position. We got 100. But remember, there was impairment of 42, of which we converted the 42 to Kenyan shilling, we got 20. So you take the 100 as at the date of the statement of financial position minus the 20, which is impairment. Then the next item you have is the loan to S. But that one, the examiner was very specific. It was included in the current liabilities. That is non-current liabilities. We subtract it at that point. So the next thing I will move is to current liabilities. So under current liabilities, we have 3530, 3550 plus 1020. Obviously, this one I could have divided by 2.1. Then I have to minus the 6. So why am I minusing 6? So on this case, remember current assets, not current liabilities. These are assets. So I've recorded wrongly. So that is assets. So for the current assets, remember the current assets contains inventory, which is the closing inventory. Under closing inventory, we always subtract, and here is profit on stock, and we add goods in transit. Under inventory minus, and here is profit on stock, add goods in transit. And you can see there was an here is profit on stock of 6. I think you show that from the first things we did. So under cash, as another item, before I move to cash, there's another item of current asset, which is account receivable or a trade receivable. Under trade receivable, we always minus intergroup owings, the outstanding amounts, and we minus cash in transit. Then under cash, we add the cash in transit. So why am I doing this? Right now, I have said under trade receivable, I minus the intergroup owings and I minus the cash in transit. Because you will find that if H owed S 100, H owed S 100 million, but by the end of the year, H is saying that I owe you S 80 million. So there's a difference of 20. So which means that the correct owings is the 80 because H had already paid the 20 and it was on transit. Of which I said if the amount is outstanding, now for the scenario of 80 is outstanding and it has not been paid, we forgo. So we forgo by crediting a debtors, that is you subtract debtors and you debit trade payables. You subtract under payable. That is why I'm doing that. Then the 20 now, which was a disagreement and H had already paid and it was on transit, again, you minus because it has been paid. It's only that it has not been received by S. You minus under the trade receivables and again you add under cash. That is a relevant transaction you do. So the only items which was under this current assets to be adjusted here, it was only the unrealized profit on stock, UPS. There was no goods in transit, there was no intergroup owings, there was no cash in transit. And that is fine. So which means that we are done with this part of assets. So we talk about total assets. So after that, we move now to equity and liabilities. So under equities and liabilities, for the ordinary share capital, very simple and direct. You record only for the parent. And the parent was in Kenyan shillings. So for the fee of the parent is 600. Then for the share premium, you do the same. So you record the parent, that is 500. Then for the retained earnings, this one needs a working. So you just write working, then you go ahead. Then after that, you talk about the non-controlling interest. You introduce the NCI to check their capital. After non-controlling interest, you talk about exchange reserve. So that one we did. Eh? So for the NCI, you need to do a working, but for the exchange reserve already we did that, and we got 88.75. Remember that we did that one, and I can display. So this one, so there was the 190, the 97 from operations and from goodwill. Then we subtracted the one going to the non-controlling interest. So we remained with 88.75 down here. So 88.75. The one from operations and the one from goodwill. We minus what was going to the non-controlling interest. Then after that, we do non-current liabilities. For the non-current liabilities, it was 300 plus. So remember that for S, it was 410. So 410, I can say, if we could have done direct, I could have divided with 2.1, of which, you know, assets and liabilities, you convert the items of the foreign subsidiary using the closing rate, and the closing rate was 2.1. That is the rate when they were preparing the relevant statements. So that is the closing rate. So after that, we talk about current liabilities. So for the current liabilities, we talk again about 2050 plus. So the 2050 plus 600, we divide the 2.1. There was no other items to adjust there. So that I say here, total equity and liabilities. So the only thing I have to subtract here, without forgetting, under the non-current liabilities is the 50. And this one they mentioned about the loan. In the additional information, they said that the loan, which was going to S, was included under the non-current liabilities. We have to subtract that. They said under note 3, H issued an interest-free loan to S of 50 on 1st May 2015. The loan was repaid on 31st May 2016. S included the loan in its non-current asset. So remember that it was paid 1 month after the end of the year. So which means that by the end of the year, that is 30th April, the amount was still outstanding. So if they could have not said that it was included under the non-current liabilities, I could have adjusted my debtors balance and trade payables, because I said that is an amount which has not been paid by the end of the year. So we need to forgo that. I could have subtracted under my debtors balances and under the creditors balance, but they were specific that it was inside the non-current liabilities. That is why I'm subtracting on that point. So this was the loan to S, the 50. Even they mentioned under the additional information. So it's the same which is under the additional information. So now we can first get the totals of what we have before we do the 2 Rust workings. But for your exam, ignore. You have enough to pass. If you can do the way I've done this question without doing a lot of workings, wastage of time and so on, because every question for the exam of CASNET needs 36 minutes. So you cannot do everything in the 36 minutes, but you can do the minimum with the examiner needs you to pass. But for the knowledge and for the guys who are gaining from my tutorials and who want to be motivated to be lecturers of tomorrow, go through everything step by step, and at the same time interact with me. I can share wisdom. So let's do the computations so for the first one, I take the 2970 plus 1460 divided by 2.1. So my answer is 3665. So this is 3665. So I can record here 3665 point, as per my calc, is 0.24. 3665.24. Then this one is direct. For goodwill, it's 80. Then for the current assets, it's all about for the current assets, I can see here under my calc, after taking the 3530 plus 1020 divided by 2.1 minus 6, I'm getting 4029.71. So that if I take the total assets, because there's nothing which is missing under assets, 3665.24 plus 80 plus 4029.71, I'm getting 7774.95. So for the non-current liabilities, 300 plus 410 divided by 2.1 minus 50, I'm getting 445.24. Then 2050 plus 600 divided by 2.1, I'm getting 2335.71. So let us finalize now with the two workings. So the two, retained earnings and NCI. So let's start with the retained earnings. So for the retained earnings, remember that for the group accounting, or we call it business combination, we always do the statement of changes in equity, which contains only the retained earnings. So what I will be doing here is the same as if they could have asked you to do the statement of changes in equity. This is what you could have done. So we start with the retained earnings balance brought down. So for H and S, then you have to add profit for the year. So profit for the year you add is for the parent only, the one which you got when you did your income statement. Then you have to raise dividend paid. So dividend paid by parent. Dividends paid by parent. So which means that for dividends paid by parent and profit for the year, for the parent, we have them direct from the question. So I can start recording them. So remember that under additional information, if I can display, there was dividends paid by the parent, which was there, of 80, I think. So this one, the parent is H, not 5. H Limited paid a dividend of 80 during the year ended 30th April 2016. This dividend had not been included in the company's income statement. So the 80. Then the profit for the year is the one which we have from the income statement, which we already did some minutes ago. So this one. So the profit attributable to parent, this 370.25. So what about balance brought down here? So remember, to get the balance brought down there, there's some items to adjust. So our financial year, remember that it runs from 30th. So our financial year was ending 30th April. So this all about our financial year was ending 30th April 2016. So it was starting 1st May 2015. So I need to get the balance brought down as at 1st May 2015, of which we know that the statement of financial position which we are provided within this question was as at 30th April 2016. That is the end of the year. So which means that here, this retained profit, the 36, is at the end of the year because this statement is as at 30th April. So I will write this one here. Then what about profit for the year? Again, you check from the income statement. That is the profit after tax anyway. So the profit after tax is all about 150. Yes, 150 or 340. So it's 340. Remember, it's for H. That is what I'm looking for. I'm looking for the retained profit brought forward for H. So profit for the H is 340, the one which is provided there. So the 340. But we need to minus the 80, which is the dividends, which was never captured. They said that in note 5. They said that the dividends were never captured in the books. If we can go through that note 5, they said that H paid a dividend of 80 during the end of 30th April 2016. These dividends had not been included in the company's income statement. So we need to subtract that because obvious, when you pay dividends, it's out of the profit. So which means that we can get the pro down. So we take 36, you minus that 340 minus 80. So what are you getting? So if I use my cal, that is my calculator. So the 340 minus 80, then 3600 minus the answer. So I'm getting 3340. So which means that here we have a balance brought down of 3340. Then this one is 0. So for you to have the balance brought down of the other investee companies acquired by the parent, so for them to be, for the balance brought down to be available for the investee companies, those investee companies must have been acquired in the previous years, but not in the current year. So if the investee company was acquired in the current year under consideration, like now, the financial year starting 1st May to 30th April. So it means that it came in this year. It does nothing which has been retained from previous years because it was not there. That is why I'm getting a 0. So for that to be there, it may be to, if it could have been acquired the previous year, we can say that last year it retained something to brought down. So that the 340, you add 370.25 minus 80. So I'm getting 3630.25. 3630.25. So that is what I'm going to record here. 3630.25. Then finally, now we can do the last thing and the last working for this question, which is concerning now the how to check the capital of the minority shareholders. So we do the NCI account. We do the NCI account. So on this side, we will have the net assets. Net assets, remember these are the equity items. And remember that I will be dealing now with S. So the equity items of S. So I will take my 25% times the total value of the net assets. So go to your translated income statement. And that is now the point whereby this translated will substantially assist me not the income statement per se, but the translated statement of financial position. So the translated statement of financial position to get the total equity. So you add this up to this point. So if I use my calc, I take 128 plus 80 plus 320 plus 75 plus 97. So I'm getting 700. So the total of these items. So 25% of that. So that is 175. Then you take goodwill, but the goodwill of NCI. And this means that we could have used the full method, but we use the partial, so there's nothing going to the NCI concerning goodwill. Then talk about depreciation overcharge. There was no overcharge because there was no sale of fixed assets. Here you talk about UPS. If there is an upstream sale, I think we said it was a downstream because it's HU sold. Then we talk about depreciation undercharge. There was no undercharge because there was no revaluation. Then finally, we talk about impairment. But this impairment to be applicable here, we must have used the full method. We use the partial. So which means that my balancing figure will remain to be 175. So these are about 175 to consolidated statement of financial position. Consolidated statement of financial position. So which means that I would fix here 175. So that in order to check if it's balancing, I take 600 plus 500 plus 3630, 0.25, 0.175, plus 88.75, plus 445.24, plus 2335.71. So you can see it's becoming the same as the one we have for the assets. So the 74.95. And that is the end of this question for today. So let's meet next time when we will be going into deeper part of this consolidation, because under consolidation of advanced financial reporting, you need to understand these foreign subsidiaries. Then again, you need to understand where the subsidiaries has been now disposed. So without being foreign, but you find that, let's say, for example, if A acquired B 80%, then A rated disposed that B, either of which that subsidiary changed to be an associate or a joint venture, or it remained to be a subsidiary. Then again, you need to know when this entire disposal, of which it can take place at the end of the year or during the year. Then again, you need to understand just a normal question, the one you did in section 3 anyway, a normal question for consolidation whereby A acquires B direct or C or D. That is a scenario whereby A acquires a subsidiary, associates, or joint ventures. Then again, remember that cash flow, International Accounting Standard 7, is part of this consolidation because they test a concept of this. But already I've done a question on that. You can check on my YouTube channel. And also we can interact more on my social platforms for any question. And my number is on the channel. We can talk about accounting in depth. So let us meet next time as we continue with consolidation. Have a nice time.